Hello everyone, welcome to my YouTube channel. In this particular video, we'll solve one more problem related to capital gains. Mr. V is a resident. He purchased a residential house in Mysore, that is in India, on 1/4/1979 for rupees 25,000 and added first floor in 1980 at a cost of 7,000. Since you all know by this time that any additions or any improvements made before 1/4/2001, we will not consider that. We will ignore. On November 2020, he gifted the house to his son Mr. A, who added two more rooms in 2023 at a cost of 20,000. This we will consider because it is done after 1/4/2001. On 1st November 2022, Mr. A sold the property for rupees 15 lakhs. Find out the taxable capital gain if the fair market value of the property as on 1/4/2001 is 75,000. So here they have given actual cost also as well as FMV, and they have given the CII also. So first let us write the basic information. So what type of asset is it? It is a residential house. When it was first purchased, it was first purchased in the year 1/4/1979 and it was sold. Mr. A sold the property on 1st November 2022. So this will be your selling date. So since it is more than according to the rules it should be more than 2 years. If it has to be called as LTCA. Here the asset has been held for more than 2 years, so it is known as LTCA. So first let us write the sale consideration. So he sold his property for 15 lakh. There is no any transfer expenses, so I write it as nil. So your net sale consideration will also be same, that is 15 lakh only. From this you will reduce two items. What are those? First one is indexed cost of acquisition. The first item will be indexed cost of acquisition. So you already know the formula by this time, but in the problem they have given actual cost also. What is the actual cost? Actual cost is 25,000, plus they have even given the fair market value of the property. The fair market value is 75,000. Out of these two, whichever is higher should be taken into consideration. Actual cost is 25,000, fair market value is 75,000. In this, whichever is higher, 75,000 is higher, divided by any year prior to 2000 and 2001, it will be 100 only. So 75,000 divided by 100 into 331, if you do, you get an answer of 2,48,250. From this, you have to subtract indexed cost of improvement. So let us check when was the improvement done. There are two improvements done in the question. First improvement is done in 1980, which we have to ignore because it is done before 1/4/2001. And one more improvement has been done in June 2013 at a cost of 20,000. That should be considered. So in the year 2013-14, they have done a cost of improvement of 20,000, and the CII of the year 2013-14 they have given in the question, it is 220, and by default the CII of year of transfer is 331. If you do this, you get an answer of 30,091. If you add these two, 2,48,250 plus 30,091, you get the total of 2,78,341. That will be the total amount which you have to deduct. So your net sale consideration is 15 lakh. From that you have to subtract 2,78,341. You will get the gross LTCG, that is 12,21,659. Since there is no any exemptions in the problem, your taxable LTCG will also be same, that is 12,21,659. This is how you need to solve the problem. Hope you have understood how to solve the problem. If you have any doubt, you can put your doubts in the comment box so that I'll respond to your doubts as soon as possible. Thank you for watching the video. I'll come back with the next video as soon as possible.